Hi, this is Michael Joyce from Agili, your personal CFO, and I'm coming to you today from our new Virginia office in the hip Scotts Addition area. We'd love to have you come over and visit our office, which we're very proud of. If you come in the late afternoon after the craft brewery is open, maybe we can even go for a beer afterwards. Our new office is still a little bit of a construction zone, so you might hear a little bit of that during the course of this video. So, the end of 2018 was not good. There's no doubt that 2018 ended with a thud. The correction that had started earlier in the fall that accelerated in December led to the worst year in the US stock market since the financial crisis 10 years ago. So what can we expect going forward into 2019? So I have 3 points. Number one, stay calm. For those of you who live or work in buildings that have multiple floors, step away from the windows and focus on your long-term goals and objectives. I know that we're in the middle of a correction when it feels like Chinese water torture. When markets are relentlessly down every day, it's tough to focus on your long-term goals and objectives. However, I'm going to talk again about studies that were done by JP Morgan and Vanguard that looked at investors over a 20-year time frame. So over the past 20 years, the stock market has had an average annualized return of 7.4%. And we're not cherry picking these time frames because these were not particularly a great 20 years for the stock market. We had two nasty bear markets where the stock market went down over 50% from peak to trough. Over that same 20-year time frame, the average diversified portfolio had an average annualized return of about 6%. But the average investor, according to these studies, over these 20 years, had an average annualized return of just 2.6%. That's barely above inflation. And the reason for this is because when we are in the middle of a correction, it's tough to focus on your long-term goals. It's easier to think about the short term. So what we find is investors are buying the hot stock after it's already gone up. They're selling when their stocks or investments have gone down. And even if they get that one right, they have to get another piece right, and that is to buy back in before they go back up. And often investors get all three of those pieces wrong. So if you align your long-term goals and objectives with your portfolio and stay calm, when we do have market corrections, it is going to help you achieve those long-term goals and objectives. Number two, the sky is not falling, but it would be good to keep your seatbelt buckled. In the correction in December, there was a narrative that there's a recession around the corner, which we don't believe is going to occur, and economic statistics that have come out are pretty much in agreement with that. However, there's still a trade war going on. We still have to worry about the 3 T's, trade, tariffs, and tweets. And at this point, the government shutdown has not been settled, and it looks to be like it will be the longest shutdown in history. So we're going to have negative sentiment out there. We're going to have bad days in the market, despite the fact that the first couple trading days in January have been pretty good. So keep your seatbelt buckled, and again, focus on your long-term goals and objectives. Number 3, it is still not yet time to get defensive, but it makes sense at this stage of the economic cycle to be careful. So the US economy still doing pretty good. Global economies are still doing pretty well as well. So we do expect that to continue. It may not be at the same pace as the past couple years, but we do expect that to continue. Also, we're looking at valuations as a result of the correction that are a little bit better than they were before. We're looking at things like energy prices, which are down a tremendous amount over the past quarter. Oil prices were down $30 per barrel between the beginning of October and the end of December. And that's a good thing. With lower energy prices, consumers have more disposable personal income, and companies that have to ship products, they're going to have lower shipping costs, so that's going to help out their earnings. We're also looking at the fact that the Fed has been relatively aggressive in raising short-term rates, and now they've raised them to a level that's about the rate of inflation, which is where they should be in a normal environment. So that means that in 2019, the Fed may not be as aggressive as they were in 2018 in raising rates, and the markets would really like that. Also, the dollar may not be as strong as it was in 2018. The US dollar went on a tear against almost every currency in the world. So if that strength abates even just a little bit, that's going to be good for international investments, and it's going to be good for multinational companies that do a lot of business overseas. And at this stage of the economic cycle, while we're not yet getting defensive, it does make sense to focus a little bit more on quality investments. Higher quality stocks, higher quality bonds, and that's what we're going to be doing. So I hope after the carnage at the end of 2018, I've given you a little glimmer of hope as we enter into 2019. If you have any questions, you can feel free to call your financial strategist or to contact me. You can also follow us at agilipersonalcfo.com or on Twitter. Thanks, and have a great day.